Ever wondered how you can lend money to the government or big corporations and make a profit out of it? Well, that's exactly what investing in bonds is all about. Bonds in their simplest form are essentially IOUs. When you purchase a bond, you're lending money to the issuer, be it the government or a corporation. In return, the issuer promises to pay you back the original amount you lent, known as the principal, at a predetermined date in the future, also known as the bond's maturity date. But what's the incentive for you to lend your money? Well, the issuer also agrees to pay you interest, typically semi-annually, over the life of the bond. This interest payment is what we call the bond's coupon. You might be wondering, why are bonds so important to an investment portfolio? Firstly, they provide a predictable income stream. The issuer is obligated to make those interest payments to you, come rain or shine. Secondly, they offer a degree of safety. If a company goes belly up, bondholders are paid before stockholders. And lastly, they help to diversify your portfolio. Bonds often perform well when stocks are struggling, helping to smooth out any bumps in the road. But before you dive headfirst into the world of bonds, it's essential to understand that not all bonds are created equal. They come in various shapes and sizes, each with their own set of risks and rewards. From treasury bonds issued by the government to corporate bonds issued by companies, from short-term bonds maturing in a few years to long-term bonds maturing in 30 years or more, there's a whole world of bonds out there waiting to be explored. Now that you know what bonds are, let's delve into the different types of bonds you can invest in. Remember, the key to successful investing is understanding what you're investing in. So buckle up, because we're just getting started on this exciting journey into the world of bonds. Bonds come in different flavors, mainly government and corporate. But what's the difference? Let's delve into that. Government bonds, also known as sovereign bonds, are issued by national governments. The money you lend to the government by buying their bond is used for various public projects and infrastructure. These bonds are considered the safest type of bond investment because they are backed by the full faith and credit of the respective government. The government can always raise taxes or print more money to pay back their debts. A prime example would be U.S. Treasury bonds, which are seen as one of the safest investments in the world. On the other hand, corporate bonds are issued by companies. Companies issue bonds to finance their operations, expansions, or other business projects. Unlike government bonds, corporate bonds carry a higher risk because companies can go bankrupt. But remember, with higher risk comes higher potential returns. That's why corporate bonds usually offer higher interest rates compared to government bonds. Now, let's talk about some unique features of these bonds. Government bonds often come with tax advantages. For example, in the U.S., the interest earned on treasury bonds is exempt from state and local taxes. Corporate bonds, however, don't come with such tax benefits, but they do offer a wider range of choices. You can choose from a variety of sectors, credit ratings, and maturities, allowing you to diversify your portfolio. So, which one should you invest in? Well, it depends on your risk tolerance and investment goals. If you prefer safety and stability, government bonds might be your cup of tea. But if you're willing to take on a bit more risk for potentially higher returns, you might want to consider corporate bonds. In the end, a well-diversified bond portfolio often contains a mix of both government and corporate bonds. This helps to balance risk and return and provide a steady stream of income. So, government or corporate bonds? The choice depends on your risk tolerance and investment goals. Investing in bonds might seem complex, but once you understand the basics, it can be a great addition to your investment strategy. Stay tuned for our next segment, where we'll dive deeper into the types and features of bonds. Coupon, maturity, face value, yield, rating. These are not just jargons, they define a bond's character. Let's start with the coupon. This is the interest you earn from a bond. It's called a coupon because in the old days, bondholders would clip off a coupon from their bond certificate to redeem their interest. These days, it's all done digitally, but the name stuck. Next, we have maturity. This is the date when the bond issuer will pay back the bond's face value to the bondholder. Maturities can range from a day to more than 30 years. The longer the maturity, the more interest you can potentially earn, but the risk is also higher. Speaking of face value, this is the amount the bond is worth when it's issued. It's also the amount the bond issuer promises to pay back when the bond matures. Don't confuse this with the market price of the bond, which can fluctuate based on supply and demand. Then we have yield. This is the return you can expect to get from a bond. It's calculated as the annual coupon payment divided by the bond's current market price. Yield is a great way to compare different bonds to see which one offers the best bang for your buck. Lastly, we have the bond rating. This is a grade given by rating agencies to assess the creditworthiness of the bond issuer. In other words, it's an indicator of the risk of default. A high rating means low risk, and a low rating means high risk. Now, why do these features matter? Because they can help you understand the risks and rewards of a bond and choose the right bond that fits your investment goals and risk tolerance. For instance, if you want a steady income stream, you might prefer a bond with a high coupon. If you're investing for the long term, you might choose a bond with a long maturity. If you're risk-averse, you might go for a bond with a high rating. Understanding these features is crucial to make informed decisions when investing in bonds. So remember these terms, and you'll be well on your way to mastering the bond market. Investing in bonds is not without risks, but with risks come returns, right? Now, let's dive into the world of bond investing and get a grip on the risks and returns of bonds. A bond, as we know, is an IOU. You're lending your money to a government or a corporation, and in return, they promise to pay you back with interest. Sounds simple enough, but there are risks involved. Firstly, there's credit risk. What if the entity you lent your money to defaults on their payments? That's a risk you need to consider, especially when investing in corporate bonds. Organizations can and do go bankrupt, which could lead to them defaulting on their bond payments. Secondly, there's interest rate risk. Bonds have an inverse relationship with interest rates. When interest rates rise, bond prices fall and vice versa. So, if you need to sell your bond before its maturity and interest rates have risen, you could end up receiving less than what you initially paid. Now let's talk about returns. The primary way you earn returns on bonds is through interest payments. These payments are usually made semi-annually and are a percentage of the bond's face value. This percentage is what we call the bond's coupon rate. But there's another way to earn returns on bonds, through capital gains. If you buy a bond at a discount, meaning less than its face value, and then sell it at a higher price, you make a capital gain. So you see, investing in bonds is like a seesaw. On one side you have risks, credit risk and interest rate risk. On the other side you have returns, interest payments, and potential capital gains. The key is to balance these two sides. Investing in bonds isn't about avoiding risks altogether. It's about understanding these risks and making informed decisions. It's about diversifying your portfolio and not putting all your eggs in one basket. It's about investing in different types of bonds with varying maturities and credit ratings. Investing in bonds is a balancing act between risk and return. And like any balancing act, it requires patience, diligence, and a good understanding of the bond market. So keep learning, keep investing, and keep balancing your portfolio. Ready to dive into the world of bonds? Let's talk about how to buy them. First, you need to decide what type of bond is right for you. Are you looking for the safety and stability of government bonds? Or are you willing to take on a bit more risk with corporate bonds for potentially higher returns? Your choice will depend on your personal risk tolerance and financial goals. Once you've decided on the type of bond, the next step is to research and select specific bonds to invest in. This involves understanding key features of bonds, such as the coupon rate, maturity date, and credit rating. The coupon rate tells you the interest you'll earn, while the maturity date indicates when you'll get your initial investment back. The credit rating, on the other hand, gives you an idea of the issuer's ability to repay its debt. After you've done your research and selected your bonds, it's time to make your purchase. You can buy bonds through a broker, a mutual fund, or an exchange-traded fund. Buying through a broker allows you to choose specific bonds, while mutual funds and ETFs offer a diversified portfolio of bonds. Remember, diversification is key in investing to spread out risk. When buying bonds, keep in mind the price you pay can be more or less than the bond's face value. This is because bond prices fluctuate in the market based on factors like interest rates and the issuer's creditworthiness. If you buy a bond at a discount, you'll earn more than the stated coupon rate. Conversely, if you buy at a premium, your yield will be less than the coupon rate. Lastly, remember to monitor your bonds after purchase. Bond investing isn't a set-it-and-forget-it strategy. Keep an eye on interest rates, as they can affect the value of your bonds. If interest rates rise, bond prices generally fall, and vice versa. Investing in bonds is not as complicated as it may seem. With the right knowledge, you can start growing your wealth in no time. So that was a quick overview of bonds and how to invest in them. We've explored the basics, the differences between government and corporate bonds, their types and features, and the risks and returns. We've also delved into how to buy and invest in bonds. Remember, investing is a journey, and every journey begins with a single step. So take that step today. Start investing. And don't forget to share your experience in the comments below. If you found this video helpful, give it a thumbs up, share it with your friends, and don't forget to subscribe for more insightful videos. Until next time, happy investing!